Hi, guys. Welcome to the 12th episode of WTW, where we talk about the weekend markets from a trader's perspective, what to focus on and what to ignore. So let's begin. As usual, we start off with a layout of the S&P 500, the market as I like to call it. And here we have Monday, Tuesday, Wednesday, Thursday. You can't really see it here. It's a little bit of a indecision candle. And Friday. Okay. First week of February, and it's starting off crazy because here on Friday of last week, this red candle here, Trump starts talking tough about tariffs and says he's going to impose tariffs on Canada and on Mexico. That was a big deal over the weekend. So because of that, the market gapped down open on Monday. Okay, so let's start talking about Monday. Okay, so this whole week it's been about tariffs and tech. Okay, that's what it's going to be. It's going to be a lot of macro data came out that is significant. We should go over that at the appropriate time. And some tech earnings came out, notably Google and Amazon. So how did the market react? Because we are in earnings season, and the market will react when the big tech names report. It gives you like an overview of how the market is behaving. Okay, because if tech does well, the whole market usually will do well. Okay, so that's what we have going on for the week. So on Monday, the big news was, of course, over the weekend, Trump slapped on 25% tariffs on Canada and Mexico because they're being unfair trading partners. Okay, so the market gapped down. Okay, not unexpected, but that's pretty small of a gap down. What was it? At 1.592 on the SPY, and we stopped at 6. So that's like, I don't know, 1.5%, but then it finished higher. Okay. So despite this tariff talk, the market seemed to sort of brush it off by day's end. And the reason for that brush off was because Mexico immediately made a deal with Trump. So Trump, a temporary deal. Trump gave him a 1 month reprieve on their tariffs because they were going to secure their border and prevent immigrants and drugs from pouring in. And Trump asked that of Canada as well. And Canada didn't respond yet. They're going to respond later. But as of right now, on Monday, that was the news over the weekend. Everybody was scared the market would open up really low. And it did, not that much, but enough. 1.5% is a good move. But not like panic, okay? So that's what happened on Monday vis-a-vis tariffs. However, we do have an important macro piece of data that came out, and that is the ISM manufacturing PMI. Okay, we do look at that. It's one of our big major macro points that we looked at. And our macro was developed on WTW1 all the way in our first episode. And one of the most important things that we look at is the ISM manufacturing, okay? So let's go to ISM manufacturing from Trading Economics. It came in at 50.9, okay, for January. That is huge. Okay, to me, this is a very, very important macro move, okay, that has gone completely unnoticed this week, because this week was all about, the Trump tariff talk and tech earnings. But this to me is one of the most significant things that happened this week and probably this quarter. Okay? Because for the manufacturing sector to finish above 50, okay, is a big deal, because now it's entering into expansion territory. Because for all this time, look, if we go back all the way, we can go back all the way to what, October of 2022 is when it was above 50. And from September, did it go here? Did it go above 50 here? No, it was at 49.8 in March of 2024. So for since November, let's say September, October of 2022, 23, 24, what is it? Over 2 years. Okay, 2.5 years, 2.25 years. The manufacturing sector has been contracting. Okay, that's bad. Now it's coming out. It's troughing, and now it's came out from contraction into expansion for the first time in 2.5 years. That to me is significant. However, it can't just be a one-off. It peaks its head above 50, and then the next month it'll go down to 49 or 48 or whatever. Okay, but so far this is encouraging. Okay, it shows that the manufacturing sector is starting to turn around in the States. So to me, that is a big deal, especially if it's sustained for the next month or two or whatever going forward. We need to see this improve going forward. Okay, and that is good. That's a good economy is good. Okay, I know the current market narrative, which is that inflation is bad. It's the bond vigilantes mantra. Okay, the current market narrative. It's that everything is going to do so well that inflation is going to kick up. Tariffs are going to kick up inflation, and we're going to have yields higher. Okay, the long-term yield is going to be higher. Okay, that is the current market narrative. But a good economy mitigates that. Okay, it's disinflationary. A good economy is disinflationary, so that's good. So this to me is a significant move for Monday. Okay, and the fact that Mexico made a deal gave hope that Canada would also make a deal going forward. So the market came back, and it was probably down. The market in total was down not even 1%, 0.67% from being down 1.5. So it made up half the drop. Okay, which is very encouraging. Okay, so let's move on to Tuesday, another good day. It covered the gap. It took 2 days to cover the Friday gap when Trump started talking tough on tariffs again. Okay, so what happened on Tuesday is the trade war continues. China imposed retaliatory tariffs on the U.S. in response to Trump's 10% tariff on China, which is, I guess it's a move that'll escalate it, but not that much. So we were talking a while back that Mexico and Canada will not be a big deal to the U.S. because their imports make up such a small percentage of U.S. GDP. Together, Mexico and Canada make up about 3% of U.S. GDP. But Canadian exports make up 20-25% of Canadian GDP. And for Mexico, it's about 30% of their GDP, their exports into the States. So it hurts them. This trade war will hurt them more than it hurts the U.S. So this is a no-brainer. We know the U.S. is going to win the trade war against Mexico or Canada. They're nothing players compared to China. Now, China, that's going to be a bit more problematic because Canada and Mexico are net exporters, and their biggest market is the U.S. market. Okay, but China is not in that boat. China is a net exporter too, but the U.S. relies more on China than it does on Canada and Mexico. So that is more of a big deal. Okay, they import more stuff from China. It's a bigger percentage of their GDP than imports from Mexico and China. So there's the U.S. will take more of a hit if they get into a trade war with China. So we should pay more attention to the China-U.S. trade tariff war than to the tariff war between the U.S. and Mexico or Canada. Okay, the only two partners that are going to show some scale or some fight or some oomph when talking about the trade war is the EU and China. But the EU is our friend, so the U.S. should sort of be able to negotiate some deals with the EU. But China, it's going to be tougher. So the main target that you should be looking at when it comes to the trade war is China. Everything else is just if the market reacts to any news about Mexico and Canada, it's going to be a nothing burger. Okay, so always fade that move. Okay, so on Tuesday the trade war continued, but the market saw right through the Mexico and Canada thing because it was, the truth always comes out. It's obvious that they're going to have really no impact and no leverage. Okay, and Trump could pretty much do whatever he wants with Canada and Mexico, and Mexico and Canada better comply, or it's going to be hell to pay for them. Okay, so That's what happened on Tuesday. We also had the JOLTS job openings, which were at 7.6 million versus 8.16 million. So there are more job openings than before. Excuse me, less job openings than before. Sign of a good economy? I don't know. To me, the JOLTS number could be ignored. It's completely bogus. It's a manipulated figure, and it doesn't add to our macro. And if you saw our macro outlook, you will see that it's nothing that we look at. The jobs report is nothing that we look at. So let's refresh and go back to the macro, to our macro backdrop. I keep mentioning it, but okay, so this macro backdrop was mentioned in November 18th of 2024. This is what we looked at back then, and this is the current macro backdrop that we have right now. And we look at a number of things to see whether we should be favorable to the market or unfavorable. The first thing that we look at is we expect GDP to hold up between 2 and 3%. Okay. We also expect jobs to hold up. If that's the case, then the market, we should be bullish. That's the reason to stay bullish, is because of the market, the macro backdrop that we have. Okay, we also look at inflation, that's key, but we expect it to be falling and yields to be low. We look at credit spreads, we haven't seen that. They're still pretty low. Okay, the VIX is low too. That's one of the things that we look at. M2 money supply is increasing, we're looking at that too. The Fed balance sheet is falling. We also look at the Fed balance sheet. Okay, the Fed is very important. And we look at, of course, the ISM manufacturing, which we just mentioned, and the services, which will come up to us soon. So ISM manufacturing, one of the most important things that we look at. The yield curve too, but for different reasons. Okay, it's not worth mentioning right now, but we're not close to a recession so far, I guess. So far, we're bullish. We look at the technicals, of course, and sentiment. Sentiment is, we always mention the fear and greed index, which we'll look at later, but sentiment is very important because we believe that we are climbing a wall of worry, and this is one of the most hated bull markets of all time. So everybody has one foot out the door, and that is positive for a bullish thesis. Okay, and of course the Fed matters. We also look at building permits and the University of Michigan consumer sentiment. These are secondary. Okay, although they are important, we should look at them. They're leading indicators. So that is an overview of the macro that we look at. So we've talked about the PMI before, but just to have an overview of what we actually look at that matters. And none of this is JOLTS or job openings. Okay, it's completely ignored, and yet the market makes a big deal out of it. And if you see the S&P 500 on Tuesday reacted to it somewhat, but you don't have to. Okay, it's don't even look at it. It's not worth it. The big reaction was the trade war, alleviation of trade war pressures between Mexico and Canada and the U.S. Okay, so that's Wednesday's action. So Mondays, everybody was scared over the weekend on Friday, open gap down, and in 2 days it made up that fear. So now let's move on to Wednesday. Okay, so Wednesday we did have some important macro data again. The services, ISM services came out. And we look at ISM, that the Institute of Supply Management, these are the most reliable numbers. This is the manufacturing one, so let's go to the services. ISM services PMI. It went lower, it went to 52.8, okay, which is still expansion, but expanding at a slower pace. But if you see, like, the services sector, as we mentioned before, is almost always above 50. Okay, let's go back 3 years. Very rare that it goes below. This is like 49, 49, 49. If you look at 5-year average, only in, like, April 2020 does it really go below 50, and then you're in trouble. Okay, so we're still above 50, no problem. Okay, the services sector is always better off than the manufacturing sector in the U.S. So is this worrisome? Not really. We need to see more of a trend of it going down and hitting 49, which I don't think is going to happen. Okay, soon, maybe later, but as of right now, in the next 2-3 months, that's not going to happen. So we're looking a quarter ahead, and that's when a quarter to 2 quarters ahead, which is what is important to us as traders. Okay, so the ISM services still in expansion, even though it was lower than the month before. Another important thing. Okay, but for me, the most important thing that came out is that manufacturing above 50 for the first time in 2.5 years. Okay, I thought I'd mention it again because it's that important. Okay, so let's go back to see during we're at Wednesday now. Okay, so another important thing that came out that wasn't even talked about in the market much is that the Treasury is going to keep its debt sales unchanged for the next several quarters. This is big. Because remember, one of the key drivers and of fear in this market was the fact that the Treasury now is going to have to, you know, issue trillions and trillions of bonds because they come due in 2025, and people were scared of that. Is going to keep rates high, et cetera, et cetera, et cetera. Another bullet in the gun of the camp that states that interest rates are going to stay high. Okay. So the fact that the debt sales are going to be unchanged for the next several quarters instead of increasing, that's hugely bullish. Hugely bullish. So that's bearish on rates. Okay, so at this point, we're going to go back to our US 10-year, which is our proxy for the market rates. Okay, as you can see on Wednesday, this is Monday. So Monday, Tuesday, Wednesday, Thursday, Friday. Wednesday, big drop. Okay, rates are coming down. This was a big drop on Wednesday after that announcement. This is huge for our bullish case. Very, very supportive of our bullish case. Okay, so if we look at the US 10-year over since 2023 here, we see that it broke the downward trend here, peaked its head above this resistance point. Resistance, we can't even call it resistance when it comes to rates. But it's still, the trend is still in a sideways pattern in reality, it's like a sideways pattern, but slightly going down. Yet this recent move could be constructive both for bulls and bears. Like the bulls on the US 10-year are the bond vigilantes. Okay, so they think, look, it went up, corrected, still making a series of higher highs and higher lows. So they have some ammo, some fodder for their case still being active. So that's why the current market narrative, which let's go back and look at the current market narrative, strong economic data, the current market narrative is that strong economic data leads to higher inflation expectations, higher rates, which is less future rate cuts, which are bad for the stock and bond markets, which means you should sell both the stock and bond markets. Okay, that's the current narrative, and it all dependent on keeping rates or yields high. Something in the market, whatever it is, strong economic data, whatever you can replace number one with, but the central theme of the current market narrative is that they're going to keep rates high. Okay. This supports this case because it's still a series of higher lows. Okay. However, I think it's going to continue to go lower. Okay, that is my outlook, and the fact that the Treasury is not going to issue more debt is very, very supportive of our bullish case and against the bond vigilantes case of higher rates. Okay? So that was a big deal that happened on Wednesday. And let's go back to the S&P 500. Wednesday's here. So this is very supportive of the market. So it made up the loss. So Monday, Tuesday, Wednesday took 3 days to make up the loss of Trump's tough tariff talk last week and over the weekend. So it wasn't just talk, he actually implemented it and then took it away for Canada and for Mexico. Okay, even Canada comes and bends the knee. Trudeau said that he will also send troops to the border and secure the border, the U.S.-Canada border, and stop fentanyl from going across the border. So he said that too. So he also bent the knee. So it's very, very, Mexico and Canada bent the knee. Okay? So that's Wednesday. But also on Wednesday, we can see, we haven't looked at it in a while, is oil. Okay? Oil also came down. This is Wednesday, this big red candle here. Monday came down too. This is the candle. Let's mark it here. Okay, this is the Monday oil move. Okay, oil went up when there were tariff talks, and then boom, down again when conciliatory against Mexico. Mexico was very conciliatory, so boom, oil goes down. Okay, and we mentioned that oil. Let's talk about oil. Oil's in a downtrend, series of lower highs, and it's coming. It's like a triangle here. It's not at lower lows, but this resistance has been hit multiple times and it's held. Okay, if it hits again and it goes down, it's not good. The more that you hit a support, not resistance, sorry, a support point, the more that you test support in a falling triangle or wedge, I don't know what they call it in the technicians, but the fact that oil, every oil spike, like we weren't falling for it, okay? Every oil spike is a reason to sell, in my opinion. I don't think oil is going to go up. Oil, to me, is a barometer. It's the canary in the coal mine for inflation. Okay, and if we don't have inflation, we don't have rising rates or whatever, we are not going to have rising oil. We need inflation. I think the next big up move in oil can only happen if inflation goes up. Even a Middle East war isn't enough to jack up oil. Okay, even here when traders were max short, this was the reaction when they unloaded. It took oil from $69 a barrel to 80. Good move if you're a short-term trader, but we're looking at the overall trend. I'm not an oil trader, so I'm just looking at oil to see if it supports or it doesn't support my bullish thesis, okay? And by the way, oil going down is very bullish for the market, okay? It makes everything cheaper, and it's very bearish for inflation. Inflation is going down, okay? So unless we print a crap load of money, I don't see oil going up. And the fact that the economy is doing okay but not amazing, it's not very hot for oil, okay? So to me, the bearish fundamentals of oil are still there, still apparent, and don't seem to be worked through. I expect this to break. Eventually this is going to break. And that's my view, because I don't see anything inflationary coming down the pike that will make oil spike. And I don't see the economy growing at 7-8% coming out of a recession. You know, like economies grow 6-8% GDP when you're coming out of a trough of the recession. So I don't see oil having any catalyst that would make it go up significantly. Okay, and I still maintain that view. I've been bearish oil for a long time. Okay, so that's my view on oil. Let's go back to SPY. That was Wednesday. So let's move on to Thursday. Thursday continued the bullish trend for the whole week, finishing at highs. And as always on Thursday, we look at initial claims. So what happened with initial claims? Well, they went up to 219,000. Last week it was 208,000. So even though it went up, it's still very low. Look at the overall trend, 5 years. Let's just look at this here. So you're still at these levels in 2022. Initial claims are not spiking up. Okay, it's not like everybody's, being laid off or anything like that. Okay, so initial claims confirms our bullish view so far, and our macro view. Let's go back to the macro backdrop. One of the first things we looked at was jobs are holding up, as are initial and continuing claims. They're a lagging indicator. And the reason we look at that, the first two are lagging indicators. GDP and jobs are both lagging indicators. They just confirm the macro that we had 3 months ago or 2 months ago. Okay? So the fact that it's holding up, it's confirming the fact that we should be bullish. And I expect this to go on in a similar fashion going forward, at least for the next 2-3 months, which is a quarter. Okay, so at least for the next quarter or two, I don't expect any breakdown in jobs. Okay, of course we have to look at it as it happens, because GDP is a lagging indicator, and jobs are a lagging indicator because they look back 1 month. Like if you look at the non-farm payrolls, which we will get to on Friday, when we look at Friday's candle, because now we're at Thursday. These are like coincident indicators. We see they're happening as it's happening at the time. So nothing to worry about here. Okay, so on Thursday, initial claims, good. That's where the market reacted to it. It's a good thing. We also had the Bank of England coming out and cutting rates to 4.5% from 4.75%. So let's look at the English stock market. Okay, it's the FTSE. We haven't done that. We haven't looked at the UK market in a while. Okay, this is Monday, Tuesday, Wednesday. They anticipated the rate cut, and the rate cut came out on Thursday, so that popped the market higher. We talked a while back on a previous WTW forecast podcast that this is a great consolidation. If it breaks to the upside, it's going to be a big move higher. Okay, it's going to be at least as high if you look at the technicals between this level, I should say this level here, the difference between here, which was like 8,000 to 8, it's like 500. We should get to like 9,000 on the FTSE, which is about here, okay, which is the size of the consolidation. Okay, that's what the technicals say. But to me, like once you broke up, retest and up, it's off to the races. Okay, so even though you're hearing bad news coming out of the UK with like terrible communist government that they have, terrible, and the things that they're doing with free speech, they're killing free speech, but whatever. The market says otherwise. The market likes lower rates. Okay, so FTSE all-time highs. Okay, the DAX, Europe. DAX up again this week. Okay, DAX. I mean, look at these breakouts. Once you it's like once you break out these levels, you keep going higher. Okay, let's look at the French market. The perennial loser. Let's see how this guy's doing. Even the loser here, up. Okay, it's not at its all-time highs, but look, for the past month or two, it's been going up, along with everybody else, despite their many woes. So you have European markets, DAX, you have the UK market at highs, you have the DAX at highs. They're all cutting rates. Inflation is not a problem there, it's going down. So you have bullish outlooks everywhere, and the States as well. The rest of the world is starting to come out and trying to join the US in this massive breakout. Okay, that's Thursday. But if you look carefully, right, let's go, So Thursday. And what else happened Thursday? Well, Amazon earnings. Amazon came out on Thursday. This is Thursday. And its earnings were pretty good. They beat on the bottom line and the top line. Top line was like barely beat, so flat on the top line. And their earnings, they beat by 25%. But I guess it was a sell the news because it was going up the whole time in anticipation of that. So you sell the news, and it finished at the low on Friday, but it actually opened up here. It didn't open up that low. It opened up at 235-ish, okay? And yet it closed at 229. And the reason for that is, we'll get to it on Friday. But Amazon earnings were okay. And also, I forgot to mention Google. Google earnings as well. Let's look at Google. Google earnings came out on Tuesday. They pretty much flat on the top line, pretty much flat on both ends, and they tanked it. Okay, they didn't like it. It came out on Tuesday aftermarket. So the tech news that we're looking at, tech earnings, is not good. Okay, but at least for these two. For the others, it was great. Meta was great. Okay. Oh, let's go back to SPY. So on Thursday we had the Amazon earnings. No, Amazon. It came out on Friday. It came up on Friday. They were down slightly. It wasn't that big. Okay, it wasn't that big of a deal. Google was down way more. Okay, so that's what happened on Thursday. And the reason is probably this indecision candle is that everybody was waiting for Friday's non-farm payroll report. Okay, so let's get to Friday right now. This candle right here, it started off very well. Opened even higher because non-farm payrolls came in at 143. I think they were expecting 170 after this big print last month. They're expecting 170 about. Yes, and they came out at 143, which is lower than what they expected. That's good for the rate cut theory. Okay, so let's look at the Fed Watch. What happened in the Fed Watch tool? Okay, on Friday. The Fed Watch tells you what the market's expectations are for rate cuts or rate hikes from the Fed going forward. So let's look at all of December. Okay. So all of December, they expect one rate cut and a little bit two. We're at 4.25. This is where we're at. Okay. I don't remember what it was last week. I bet you it's pretty similar. Okay. They're expecting pretty much one and maybe two rate cuts. One is the predominant. Okay, maybe a bit, this went a bit lower from last week. I can't remember what it was last week. So it was, I'm guessing it's pretty similar to what it was last week. We would have to look at WTW of the previous week to see exactly what it was because we covered it then. But I'm guessing that was pretty good for rates, or maybe a non-event, worst case scenario. Okay, so the fact that non-farm payrolls came out initially, we're looking at this candle, the Friday candle. Okay, let's blow it up. Let's go to the 15-minute chart to show you exactly what went on today on Friday. I'm recording on Friday. So this, let me mark it. This is on market opens 9:30, gap up. Okay, 9:30, 10, and then by 10 o'clock, smashed. This is when we had, you guessed it, tariff talk. So the market was doing well. It was digesting the non-farm payrolls very well. And then Trump came out and said he's going to... actually, Trump didn't talk at that point. This first move down was because of the University of Michigan came out with inflation expectations. Okay, let's look at the inflation expectations of the University of Michigan, which I never heard of this metric before. Okay, but it seemed to move the market. The University of Michigan is usually for our sentiment, consumer sentiment, but they came out with inflation expectations for the next year, and they think it's going to be at 4.3% versus 3.3% last time. So they think inflation is going to increase by 1 percentage point over the current year. Okay, which is a huge jump. Okay? And I don't know why the market reacted to it this badly. Okay. But there it is, and try to make a comeback. But as you can see, throughout the whole day, I think around here, around noonish or 11, is when Trump came out and said he's going to slap reciprocal tariffs as early as today on Friday. And that's when the market really went even lower. Okay, so you had a double whammy. You had the University of Michigan inflation expectations, which I never heard of, move the market. I mean, who takes the inflation metric from 4.3, it was 3.3%. They thought inflation for the year was going to be 3.3, and I think it's going to be 4.3%, which is crazy. That's just inflation that high for the next year. Something must have happened. I think it must have been an error. This makes no sense. I don't know their reasoning. I don't know what they do. I don't know their metric. That's why I don't follow it. But I guess the market reacted to it, and the market followed it. But as soon as the market was coming back, trying to digest this and probably dismiss it, Trump comes out and says retaliatory tariffs. And that's what hurt the market for the rest of the day. Okay, so let's go back to the daily chart on Friday. Oh, let's get rid of this one because it's for the 15-minute chart. Okay, so this is the daily chart of the S&P 500. We're flirting close to highs, okay? Flirting close to highs. So when that happened, when you had these like the University of Michigan inflation expectations increased by 1 percentage point, market tanked. Because the market is still caught in this current market narrative that higher inflation expectations will lead to less future rate cuts. Okay? More inflation means the Fed is not going to cut, that's obvious. So they're back to this current market narrative, so you sell. That's what they think. Okay? So this tells you right off the bat that we are still caught in that narrative and that this market is hated. Any mention, any bit of inflation that is gleaned from the data. Okay, and this is data that nobody looks at. Who looks at the University of Michigan inflation expectations number? Nobody. This is the first time I heard of it. But the market now reacted to it, which means it's super sensitive still to higher inflation, which is the bond vigilantes mantra. Higher inflation will lead to higher yields to fight the inflation, which means higher U.S. 10-year yields. Okay, so Friday shows that the market is still worried. And we can see it by if we look at the fear and greed index, which I like to look at. It's at fear. It's at fear. We are literally, okay, like as you can see from our macro, this is just one thing that we look at, and we look at it in the context of the other macro elements that we like to look at. Okay, so where is it here? Where did we put sentiment? Here, sentiment. We are climbing a wall of worry. Every time the market falls, people panic. Okay, they have one foot out the door. This is why we look at it. We look at it in context of our bullish narrative, because if people are bearish or react to something that is, bearish at all-time highs, that to me is bullish. Okay, because markets don't top that way. Okay, markets don't top when everybody's already fearful, and we're literally not even like what? The highs are 610. We're at 600. That's like 1.5%, not even maybe 1.5% from the highs, and we are at fear. That's a wall of worry. Okay, that's why we have all of these choppiness here. Tariff talks, wall of worry, boom, boom, boom. It's going to be super volatile. Okay, and notice the pattern. This is a Friday. Trump talks, negative, boom. Friday goes down. This is another Friday. Trump talks, Mark. Trump talks again on Friday. Notice that Trump talks on Friday, scares the market, and then comes back Monday and it rips it, and it comes back. Okay? So all of these elements, the bond vigilantes, the inflation fears, people are still afraid of this market. People still have one foot out the door. People are still fearful. We should be at greed or extreme greed when you're like close to the highs. And look, you have gaps down covering. This kind of action, this kind of adds to volatility. This is like the Trump tariff talk, plus one foot out the door, plus any inflation thing that can grab on. People are still scared, which is extremely bullish to me. This is what I want to see. I want to see this kind of like sentiment of like, I don't like this market. I want to sell at every little bit. It's going to be bad. It's going to be bad. Fear, fear, fear. Sell, sell, sell. At highs, to me, this is very, very bullish. Okay? So this is how I view the whole, actually, ever since December. Look at the choppiness. Look at the consolidation. Okay? It's getting the technicals flat. Plenty of fuel to keep going higher. Okay? Plenty of fuel to keep going higher. And sentiment is not very negative. It's negative. It's at fear. It's not an extreme fear, but still a fear near highs. I don't believe it. So, I mean, I believe it, but I'm just saying that this is not how markets top. This is why for the week of the 3rd, the first week of February, I still remain bullish, and I'm looking forward to next week to see what Trump does and what the market will do. And given all of this fact, given all of these facts that happen, the positive macro data, plus this worry, you should stay bullish.